Welcome to the American Dream Builder and Investor podcast, where our vision is to inspire busy professionals, especially first and second generation immigrants and Americans, to explore the state of the American dream in 2022 and beyond. That is the Trinity of Freedom: time, financial, and geography freedom. I'm your host, Missy Liu, and I have achieved financial independence, and I'm helping many others to do the same. I started out with $5,000 and have really built wealth for my family along the process. Now, I'm on a mission to help hundreds of thousands of people like me to do the same.
We are actually live here. So thank you so much for joining. I know it's a little later in the day for you.
Yeah, today was an exciting day. I'm excited to do this. My day actually was running late for what I was busy with. Is something that really got me in the right mode for this presentation. Maybe I'll even share some details.
Okay, awesome. Well, we may have a few people joining live here. I know this is a recorded podcast that we'll have in our iTunes and other places for the podcast on our website as well at lifemissioncapital.com. And just for those that don't know, my name is Missy. I'm the managing partner at Life Mission Capital. And we help people passively invest into commercial real estate so they don't have to worry about tenants and toilets, and they get to focus on their freedom goals. Currently, we helped investors invest into a little bit over 1,000 units of recession-resistant assets in real estate. And with us today is Bernard. So in today's passive investing made easy series, I really want to talk more about the retirement funds with Bernard, about how to correctly use your retirement funds for real estate investments. Because a lot of our investors and people we know out there, they have a large size of retirement funds that's just completely either in the stock market or index fund in general. So I want to introduce you Bernard Reisz. He's a CPA. He founded ReSure to deliver real estate tax and financial tools based on professional expertise, going beyond the execution of real estate tax tools to include experts and unbiased investor education. And I've seen some of the educational materials he has and some of the products he provides. I thought, he really feels a need in the real estate retirement products market. And prior to funding ReSure, Bernard also served as a director of the CoMetrics Partners, managing an array of engagement involving financial consulting, due diligence. He also advised owners of closely held middle market companies on advanced tax mitigating strategies. He also spoke on multiple legal forums. He usually, is really good at just giving straight talks and helping investors understand not just financial products out there, but also from a CPA's perspective. So I'm super excited to have you on, Bernard.
Okay, yes, firstly, thank you so much for that introduction. So my focus today primarily is delivering real estate tax and legal tools as contrasted with doing tax returns and doing the things typically associated with a tax accountant. But the idea really here is to bridge that gap between tax professionals and the tax tools. There's a bit of a yawning chasm. People, get a tax tool, not knowing exactly, how that impacts their personal tax return, and not always recognizing that there's a huge amount of potential complexity to the tax tools, and they should demand and expect a professional approach to their tax tools, just as they should and do from their tax accountants. So the focus is cost segregation, 1031 exchange, self-directed retirement accounts, and title and escrow. And tonight, I think we're going to talk primarily about self-directed retirement accounts, but the overarching concepts that we're going to be talking about are really apply across the board. So the big takeaways are going to be both technical stuff regarding self-directed retirement accounts, but also bigger picture items about how to approach tax tools. That being said, any particular items at top of mind for you?
Yeah, I'll ask some introductory questions and then I'll let you deep dive into some of them. And then I think we'll have some audience ask some questions that maybe a little more specific to their own situation as well. So most people know that they have their 401k or traditional IRA funds. And can you explain to people in general, what is a self-directed account or solo 401k? How is that different from the traditional retirement accounts that's out there? Yeah. So that's the one question. And then the third thing is about when do you use which one? And then the last thing is really kind of the core of this presentation, the structure. There's different pricing structure, legal structure, perhaps as well. What are the things you've done for your clients that help them to structure it correctly? Or stories of how it wasn't structured correctly. So that's kind of really the core of the conversation that we talked about. And feel free to take it to the direction that you feel is most easily understood by the audience.
Okay, amazing. Let's do this. In my mind, the organization of this is really understanding why you use retirement accounts and why would you use self-directed retirement accounts? What's the benefit of it? What's the upside? Why would you use that for real estate or any other kind of asset? And then we'll talk about we're actually understanding how this industry works, taking like kind of showing folks what's underneath the hood. Who are the players in this industry? What are the different service models? And some things that really miss, unless you have really a trained eye, you can't be expected to really discern. So the first thing is understanding what these are, why would you use them? So retirement accounts in general are tax incentives that Congress gave us because they know that Social Security is not going to do the trick, right? Even if it's around and it doesn't go bankrupt, it's not, nobody's meeting their budgets today based on Social Security, and it's not anticipated that anybody will. So Congress said, hey, let's incentivize people to save on their own. So the way Congress does that is they give you tax benefits. They give you benefits, and that's what drives us to take certain behaviors. Real estate, more than anything else, has some incredible tax advantages that Congress put there. Congress knows that they're there, and Congress wants them there. And when Congress doesn't want them there, they can take them away. That's not what we want. We want them to stay. So what are the two of those things are tax deductions, tax deferral. That's one category of things. And the other category is what we call Roth. So those are two different types of retirement accounts offering two different types of tax benefits, which ultimately translate into huge financial benefits. So what are those? In what we call a traditional IRA or traditional 401k. And in this context, we don't mean traditional as in opposed to self-directed. We mean the type of IRA that you get a tax deduction for putting money into. And for the time that the money is in there, you can invest it without paying any taxes on those returns. But when you take the money out, eventually it is taxed. That's contrasted with a Roth account where you get no tax deduction for putting the money in. However, when you take the money out throughout the time that it's in there, and including when you take it out, you don't pay any taxes on that. Each one has their place, super powerful. And it's to look at too many people and too many tax accountants actually only see retirement accounts as a way to get a tax deduction, right? So you do your tax returns and sometime in April, your accountant says, oh, I finished preparing your return. You know what? Your tax bill can be reduced by X thousands of dollars if you put money into a traditional IRA. Your tax bill can be reduced by X dollars if you put money into a SEP IRA, or by X number of dollars you put into a 401k. That's kind of the way accountants see it, which is important, but it really doesn't capture the full benefit. Accountants will very seldom call you up and say, put money into a Roth IRA. Why not? It doesn't affect the tax return, right? It doesn't get a tax deduction. But when we understand the real power of these accounts, you'll see why sometimes a Roth is the way to go. So when you get the biggest expense we each have each year on our income, on our investment returns, are potentially our taxes. Now, the impact of $10,000 taxes paid this year is not just the cost of that $10,000, right? It's also the returns that you could have earned on $10,000, right? So it gets compounded each year, right? Each year that you pay taxes, your real cost is how much would you have today had you not paid taxes for the last 30 years, right? And that is a staggering number, right? And it increases with time because compounding is something that accelerates with the passage of time. When we put this in a spreadsheet, yeah, with tax, without taxes, the first couple of years, it's like this, and then it's right, no taxes, and all of a sudden you have hundreds of thousands of dollars or millions of dollars more because you're not paying taxes. That's the name of the game. With Roth accounts, that money is never, ever taxed. So that's Roth versus traditional concepts that we need to understand and bring them over to self-directed. But a key takeaway, I think, is more conceptual one. Let's not look only at this year's tax return. That's taking a way too narrow view. Let's look at the big wealth building picture, the big financial picture. That's what the real value of these accounts are.
Bernard, if I can interrupt and just kind of highlight one nugget that you just talked about, like the Roth one. It's really good when you have something that's huge appreciations because, like you said, you already pay tax on it. So, tax-free money from there on, and why not, hit it to the moon, so to speak.
Absolutely. And again, commercial real estate, what's the beauty of real estate? If you're getting cash flowing real estate, more or less, hey, you got a nice, healthy, safe investment. But it always has that possibility. Sometimes it's planned for, but sometimes it's unplanned for. All of a sudden, some zoning law changes, some big company moves in, and now all of a sudden the asset that you got into in a syndication, right? It's not going to happen typically to a single family residence. But if you got into a syndication where the asset was purchased for $20 million, that could be sell for triple that amount, right? I've seen it happen. So very seldom can you actually plan for that. Occasionally you can, but it's always there. With an index fund, that's never going to happen. I love index funds. Everything has its place, but getting that incredible pop is just not going to happen there. So absolutely, if you're putting, investing in, depending if you're going, D, C, B, or A, depending where you're at, it's an asset class that's more likely to have that pop. Yeah, Roth might just be the way to go.
Got it. And how do all these things you just mentioned, and even more details on this for tax strategies in general, how does that translate into the self-directed accounts or the solo 401k?
Yeah, let's do it. So what are self-directed retirement accounts? This is not a term that you're going to find in the tax code. Self-directed retirement accounts is more of a marketing term / just informational term, right? When we say self-directed in this context, we mean to say an IRA or 401k or qualified retirement plan without any artificially imposed restrictions. If you look at the tax code, is it okay if I do a screen share?
Yes, but try to walk through it verbally, just because this is also a podcast episode.
Okay, yes. So, right, when we look at tax code, is there a special section of tax code that says, hey, there's an IRA for stocks? There is not, right? We've got IRC 408. I'm actually put tax code up here. Individual retirement accounts. You're not going to find a word here about investing in stocks or real estate, right? It pretty much is silent about what's allowed as an investment. We'll go to the next section of the tax code. That's 408A, right? That's going to be Roth IRAs. Nothing here about what you're allowed to invest in. So when you get an IRA at your typical financial advisor or financial institution, they are imposing artificial restrictions on what you can invest in. Now, not faulting them for that. Their business model is built on getting your money on their platform and then making money off their platform, right? And so oftentimes people say, hey, I'm getting a free IRA, right? You're not getting a free IRA, right? The hidden costs are always the one that you have to look out for most, right? And those are usually the most expensive, the ones that you can't see. So whether you're getting a low-cost IRA at a brokerage company, right? They're not in the IRA business, they're in the asset business. And they're making money on your money, and they're entitled to, but they're going to say, hey, you can only invest in what's on our platform. That's to be expected. Now, what happens if you want to invest in what the full array of assets that the IRS allows? Well, you're not going to be able to do that through your financial advisor, and you're not going to be able to do it through your typical free online IRA, because they are restricted from providing that to you based on their business model. So if you want to get invested in real estate, hard money loans, cryptocurrency, precious metals, merchant cash advance, you name it, almost everything is allowed. Then you have to get an IRA from a company that is not there to sell you assets, but rather a company that's there to help you get an IRA and has no vested interest in you investing in one asset over another. Now, that is what we refer to when we say the self-directed IRA space. Of course, if you get an IRA at Charles Schwab, that's also technically self-directed because you can pick whichever stocks you want. But if you try to buy syndicated real estate, that's not going to be available to you.
Mm-hmm. Yeah. So essentially, that's what self-directed accounts with solo 401k does. It provides you with more array of assets that's not necessarily restricted to the options on their platform. And as we're talking here, we already have some questions queued up. So let's speed up a little bit on our content here, just to make sure we have time to accommodate their questions.
All right.
And let's talk about the structure piece. What are the top mistakes? Because last time we talked, you saved some people, right, from incorrectly structured self-directed accounts. Tell me top three situations you've seen how people didn't structure their self-directed solo account correctly, and what are the things that you did to help them correct it?
Okay, let's do this. So the first thing is matching the right account to your profile. Some people don't have that. Some investors are not given the right account that it's matched to their profile. Number two, the account has to be set up the correct way. Number three, it has to be operated correctly. So there are 3 points that we have to look at. Number one, getting the right account type. Number two, setting it up correctly. Number three, operating it correctly. So there are folks out there that do not have the optimal account type for them. So we've got a flow chart here, right, that we use. It simplifies, right? Now we don't want to oversimplify, but we realize that, hey, we want to try to streamline things for investors. So there are qualified retirement plans and individual retirement accounts. Those are 2 groups of accounts. A 401k is a type of qualified retirement plan. So typically our preferred option when possible is to use a 401k. However, not everybody is a fit for a 401k. So you have to have the right tax profile to establish a 401k. The key things we're looking at, number one, do you have a business? A 401k has to be tied to a business. A 401k, by its very definition, is a trust created for the benefit of employees or a self-employed individual. So somebody that does not meet that definition, even if they get a set of documents that say qualified retirement plan, QRP, 401k, or anything of that nature, if they do not have the correct tax profile, it's not a qualified plan. So you have to get it matched to your profile.
So in the example here, for example, Chris asked, I have 401k, I'm a current W-2 employer, but I also own a business, a single member LLC with business activities. No earned income, passive only, for example, passive investing in syndications through LLC. Does that person or Chris qualify for a solo 401k account?
Nope, they would not. And not to say that there aren't folks out there that are getting that. It doesn't really matter. Unfortunately, it has become a productized space. But yes, if it's passive, that's not going to work. So there are people that should have a qualified plan that have IRAs, but they're not well served, right? And there are people that have qualified plans that should have IRAs. The errors go both ways. There is no best plan. It's always about what is going to be the best fit for your tax profile. There is a video in here about, we're not going to go over all that now, but selecting the best self-directed retirement account. So if folks want to watch that, that is available here. So now let's get back to, that's one thing. In the setup, getting the account that's going to be best matched to your needs. Number two, let's talk about actually setting up the plan. Right?
For now, let's stay on that setting up to your needs real quick, because we also have a question about UB taxes, because that's also related to your needs. So UB taxes is unrelated business taxable income, especially as it relates to self-directed, checkbook enabled, IRA, etc. So how does that work in terms of, should that person be worried about UB taxes or not when selecting which options?
So here, I'm going to try to simplify again. UBIT is definitely something people have to be aware of. UBIT is definitely a factor for determining which retirement account structure to select. However, it is never the place to start the discussion. Why is that? We're going to back up a bit. So number one, even if there's some sort of UBIT benefit to establishing one account over another, establishing the wrong type of account is not a remedy. It only makes it actually creates problems, right? So of course, UBIT is a factor, but starting the discussion about which account type to select with UBIT is to completely go kind of down the wrong rabbit hole. Let's start with, why do people invest in real estate using self-directed retirement accounts? All of this discussion about tax benefits and financial benefits of tax incentives are all start and end with a good investment. Ultimately, if poor investments, tax benefits are meaningless. What tax tools and incentives do is amplify and magnify incredibly the upside of good investments. So folks that are getting into using their retirement accounts for real estate investing are doing so because they see the financial benefit of using these accounts for real estate. Now, let's talk a little bit how UBIT works within the context of multifamily real estate. So, number one, and I'll talk about some of the things that have been out there on the web that have misled people. So the first thing you'll hear is that the UBIT tax rate is 39%. You're paying 39% on all your income. So there are a couple of fallacies there. I think by today, maybe enough good information has gotten out there, but I'm going to talk about some of the fallacies that were very strongly promoted. So the first thing to understand is UBIT, in the context of multifamily, is assessed on only the portion of the return that is leveraged. So if you're using financing, right, you're getting a loan to finance your real estate, you may end up with what we call UDFI, right? So does all of the return on the investment create UBTI? The answer is an emphatic no, right? The return on the principal invested is not subject to UDFI. It is only the return on the leverage. So the way to make it clear is to take a step back from syndicated real estate. If I present an investor with two options, here's what you can do. You have $100,000 in your retirement account. You can buy a single family residence, all cash, or you can buy a quadplex because the bank will lend you money with your retirement account and you'll have to pay UDFI. Which one are you going to choose? Any takers?
This podcast is sponsored by Life Mission Capital, founded by me, Missy Liu, where my life mission is to help busy professionals invest well so they can focus on what matters. All my life, I was taught to study and work hard for my freedom. Until one day, I realized that unless I let my money work hard for me, I will always be trading my most precious resource, time, for freedom. Since then, we have also been helping our investors passively diversify into more than 1,000 units of recession and inflation-resistant alternative investments, such as multifamily, mobile home parks, short-term rentals, and more. There are more with our free ebooks at lifemissioncapital.com.
Yeah, I would say with the UBTI, we're talking about UBTI or the other one?
UDFI is kind of a subcategory of UBTI. That's what it is. And that's what applies in this context of commercial real estate, multifamily, is because there's debt. So if you're going to buy, somebody has the option, all cash single family or 4 units with debt, and they'll get UDFI. Which one do they choose?
Yeah, I think if you run the numbers, probably the bigger one will work out better even with the taxes.
So the thing to understand is, firstly, the UDFI, right? Your cash investment is never going to be subject to UDFI, right? So that $100,000 of equity that your retirement account put in, the return on that is never going to get taxed, right? The question now is, do you want to get another 3 units and pay taxes on the return on only those 3 units? Yes, no brainer, right? No brainer. Now, so that's number one. It does not, when there's UDFI, it doesn't all of a sudden make everything taxable. It's just a portion of the return that's leveraged. Number 2, you're entitled to all the deductions that real estate gets, right? So if anybody has invested in syndications outside of their IRA, they'll know that they're getting distributions, but box 2 on the K1 is showing a loss. Are you going to have UDFI? Not likely, because if there's a tax loss, right, you get all the same deductions. So it's not as if the moment any portion of the income becomes taxable, the same portion of deductions become available. So I think it's starting to sound very appealing, right? Hey, this UDFI thing is not a problem. Now let's take it further. Another thing that was promoted out there that's misleading. So where do you really typically end up with this UDFI stuff? It's at the sale. What's the tax rate on sale? We're talking 15, 20, 25%, right? Depending on how it flows. So all in all, once we put UDFI in perspective, we realize, number one, even if UDFI was awful, it's the wrong place to start the discussion. There are folks that start the discussion there, but it's not correct because it pushes people into setting up accounts that are kind of disqualified from the get-go. They're just not qualified plans because it's not a trust established for the benefit of employees or a self-employed individual. And now once we have in context, it's like, okay, some people are like, if there's UDFI here, I'm not using an IRA. It's a shame. It's a shame that information gets out there because UDFI bite just doesn't take away from that financial incentive. Remember, we're getting into real estate. We want to get into real estate because it's a hard asset. It has higher returns. It cash flows. It has the ability to appreciate. It's diversification, or you can go all in, whatever your financial philosophy is. The UDFI is just almost immaterial within that context. So if you take the narrow view, I'm going to have to pay $5,000 of UDFI. Whoa, no way. Okay, I'm staying in index funds? No, right? Because you're giving up the real. You got to keep an eye on what on the big picture, and then say, okay, I'm getting into real estate with my retirement account because this is my financial incentive.
Yeah. Oh, yeah. Just to summarize on that, essentially run the numbers to see UDFI is not where you start the decision. It's a variable you need to consider, and it's only taxed on the leveraged amount. And you also get the deductions when you get taxed on that. You also get the corresponding deductions, and it's a long-term capital gain tax at sale as well that you need to be considering. Not a 39% essentially, right?
Exactly.
Awesome. So with that, we talked about kind of the profile piece, and then I know we drilled a little bit more into the UB, IT, or UDFI piece. But so the first thing is to figure out your profile as a customer, or who needs to have as the beneficiary of the trust, or solo 401k or self-direct IRA. What's the next step?
Okay. Once you determine the right account, broadly speaking, are we going IRA or 401k? Then it's, okay, how are you going to get it set up? And some of the nitty gritty of actually the little stuff that you may not even, may gloss over. So let's talk about some of that. Some way to talk about it is talk a little about some of the perhaps errors that I've seen that are out there. So number one, let's talk IRAs for a moment. On the IRA side, there are two options out there technically. You can get what's called checkbook control, or you can have custodian control. The custodian control business model, you have a custodian kind of similar to having a Charles Schwab, and they control and hold all your money. Any distributions go to them, and any paperwork, any funding, any execution that gets handled by the custodian. In the checkbook control model, the checkbook control is a way of putting the custodian in a bit of taking the backseat role and giving the investor direct control over their money. Conceptually, the way this is achieved is the IRA makes a private equity investment. Just like your IRA can buy stock in Amazon, it can buy stock in private companies. So the idea behind what's called a checkbook IRA is setting up a private company that you have direct or indirect control over, and all the IRA funds end up inside of that private company. And then when, hey, you have a syndication to invest, you can just wire the money in because you have direct bank account control. The subscription paperwork does not have to go to the custodian to review and sign. You don't have to do the custodian paperwork. The custodian adds their own layer of paperwork that has to be executed by the investor and the sponsor. It kind of just streamlines, makes things faster, smoother, reduces cost. Is there a downside to checkbook control? It sounds amazing, like almost too good to be true. Nothing is guaranteed in the world of taxation, but the IRA LLC structure has been around for several decades now. There are thousands and thousands and thousands of these. The IRS is well aware of them. The tax court is well aware of them. The tax court, this is actually a good one. Very recently, there was a tax court which somebody got in trouble with their IRA. They did something. There's a company out there that was telling people that you can buy precious metals, or actually coins, in your IRA LLC and keep it in there and keep it at home. Right? And they got caught, and that was a pretty expensive mistake. Right? Now, the company that's around for a long time that said, hey, you can do this. Right? The IRS, has been saying for a long time, they've indicated they don't like that. So there was something called the McNulty case. Now, there are people that have misrepresented what was said in the McNulty case, and they have represented it as the McNulty case being the end of checkbook IRAs, right? But what did the tax court actually say in the McNulty case, right? A self-directed IRA is permitted to invest in a single-member LLC, right? That was not the problem here. What the McNultys had was what we call a checkbook IRA using an LLC, right? Their IRA had an LLC that was owned by the IRA. They managed the LLC. They bought coins, golden eagles, and they kept them at home, right? The tax court said, this is quoted directly from the case. A self-directed IRA is permitted to invest in a single-member LLC. That was not the problem. If anything, this court case reinforces the validity of the IRA LLC structure. The problem was that they kept the coins at home. And this is going to be almost spooky.
So they essentially kept the coins at their home. So is this where the conflict of interest comes in?
So if the conflict of interest doesn't have anything to do with IRA LLC or not IRA LLC.
Okay.
That's not a factor in that decision. Now, this tax court case was published on September 18th, 2021.
November 18th.
November 18th, 2021. I'm glad I'm screen sharing. The words of the tax court were, IRA owners cannot have unfettered command over the IRA assets without tax consequences. Mrs. McNulty had unfettered control of the American Eagle coins and was free to use them in any way she chose. An owner of a self-directed IRA may not take actual and unfettered possession of the IRA assets. Right? So it's all about unfettered control. The problem was that she kept the American Eagle coins at home. Up here, I've got an email. If you see the date here, November 10th, 2021. This was a consulting client that wanted to invest in cryptocurrency with their IRA. And they wanted to use a product that was out there, by, again, a company that is out there for well over a decade. And I wrote to her, much of the questions are tied to the fact that in certain arrangements, you're getting, can you see what that says?
Yeah, unfettered control. So explain what is unfettered control in the RA sense, that, so that we can watch out for when we are wanting to be okay with being the custodians of our self-directed RA with a solo 401k.
So the trouble begins when you have an asset that you have physical possession over, that is in no way linked, or it can be an intangible asset, cryptocurrency as well, that is in no way linked or tied or titled to your IRA. So having an LLC bank account, right, where the cash is clearly in the LLC bank account, does not appear to be a problem. But say you take cash out and you say, oh, I'm holding this cash because I'm the manager of my IRA LLC. That's a problem, right? So we've been telling this to our clients for years, right? But this case really shook up the industry because there were many players and providers that were not abiding by this. The case was published on November 18th. This email is November 10th. And the tax court, we'd almost think they were reading, somebody was, somehow got access to our emails. So there are issues both in structuring and in operation. Just because a company sells or provides self-directed retirement accounts doesn't mean that the structure is guaranteed or that they're really focusing on providing the ultimate in compliance to keep you safe. Because all of the upside of these accounts, which are really high, it would be a shame to jeopardize that, because if you have a prohibited transaction, right, and that's what we're talking about. Let's get back to what you call the self-dealing. So self-dealing is doing, and prohibited transactions are doing something so that you so that you benefit personally from the retirement account. Now, of course, you benefit indirectly from your retirement account. The more it grows, the more money you're going to get. But the idea is you're actually going to be able to benefit from that when you take the money out of the retirement account. If you somehow are benefiting from it today, personally, that is self-dealing. And then there are certain things that Congress said, we call these the per se prohibited transactions. We can't go out there and analyze and argue over every single transaction, right? So there are certain things that we're just going to say are automatically treated as a prohibited transaction. And so those are, if there are any transactions between yourself and your own retirement account and certain other disqualified persons, that's automatically a prohibited transaction. You can't argue that it wasn't really for my own benefit. No, there's no leeway there. But there are other things that, even though it's not a clear prohibited transaction, the IRS says, nah, we think you did that because somehow you are indirectly benefiting. That could be a prohibited transaction as well.
Okay. This is a good time to ask some of the follow-up questions from the audience. And I think I know the answer. One person asked you, invest your self-directed RIA funds into a syndication LLC when you're a GP, and also invest in non-tax deferred funds. Sounds like self-dealing to me if we were to do that, right?
Yes. Here's a general rule. There are certain transactions that if you really, really want to do them, you want to structure them as optimally as possible. But my general approach to this is, there are so many wonderful opportunities out there without skating on thin ice that why go there? It's just not worth it, because you're giving up so much potential upside that you can get with things that are completely above board. Better to stay away from those things.
There's another question because we talked about disqualified person. So this person's question is asking if there is a loan to self or others related by blood or marriage, is there a need to make loans at certain minimal applicable federal rate? I think he's talking about using the, self-directed account.
So here's the thing: if the loan is to somebody that is actually a disqualified person, it's a non-starter. Can't do the loan, even if it's arm's length transaction, because it's automatic prohibited transaction. But what happens if the loan is to somebody that is not a disqualified person? If it's a below market interest rate, right, that does open it up to scrutiny and saying, okay, which investor provides a below market interest rate? An investor that's getting some kind of
Benefits in some other shape or form, which is potentially self-dealing, or potentially being viewed as self-dealing. So what's considered as disqualified people in this case, disqualified person?
Okay, so the general rule, and this is something that's actually one of these is going to be overlooked. Two things get overlooked very often by custodians. I think there's one thing that worth highlighting is that there are financial products that are out there, and there seems to be a measure of tax advice that some of these providers purport to provide, and really the best custodians are the ones that are silent about taxes. Now, today, that was my lead up, right? I had a conversation for 2 hours with somebody that has very serious issues inside of their retirement account because they were getting the advice from their custodian, and they could have spared themselves a lot of, heartache by getting real advice, when they set the accounts up. But let's talk about another thing that I see. So let's talk about actual setting up of an IRA LLC. So, and it ties into prohibited transactions as well. So let's say you have an IRA LLC, great structure. So now you have an LLC that's owned by your IRA. An LLC has annual fees, right? Stake fees possibly, an annual filing. How do you pay those? How should those be paid? Who should pay those?
It would be paid at the LLC level, right?
Yes, amazing. But there are structures out there that are very, very heavily promoted that in essence have investors paying all the compliance costs of their LLC out of their personal credit card every year. Now, that's definitely not the optimal way to do it. It creates unnecessary risk for them. It's a mass marketed product. Another thing, let's talk custodian advice. So I've actually had somebody, so the initial fee cost of setting up the LLC before it's owned by the IRA, we're comfortable with that being paid from personal funds. It's not yet owned by the IRA. Somebody paid for advice related to their self-directed IRA on a personal credit card. They had a conversation with their custodian, which is fine. So you get advice, right? You get consulting, and the contrary, you should pay it from your personal credit card. Don't pay with the IRA money. So they put it on a personal credit card. They spoke to the custodian. The custodian said to them, all IRA expenses should be paid from the IRA. They told the custodian, hey, you know what? I paid for this consulting and I put it on a personal credit card. The IRA custodian said, no problem. You know what you do? When you pay your credit card bill, pay it from your IRA. You know what that is? A prohibited transaction.
So kind of as we're talking here, we touched on from setting up the right profile and then setting up the right structure, and we're kind of slowly moving to the transactions piece, operations piece, right? Is that kind of the third tier anyways, right?
Let's try to do it. I'm going to talk just for a moment about 401k side, just to illustrate that these errors occur on the 401k side as well. On the 401k side, there's a document out there that's floating around used by many, many investors. A 401k document cannot have discriminatory language. Now, when we set up a 401k, and we want it to be a solo 401k, ideally, so we want to be able to include the business owner and exclude anybody else. It's a minefield. The moment somebody has part-time or full-time employees in any business that they own, that becomes a potential minefield. However, there are documents out there that have tried to skirt that, and they put into the document that these certain exceptions to plan eligibility don't apply to the owner of the business. That's called discriminatory language that would disqualify the plan document. So when you set up a 401k, the backbone of the 401k is the plan document. Let's transition to plan operations. What plan operations is something that we can talk about for really hours and hours. My preference, really, to simplify this is Where these accounts are a no-brainer are investments where you are somewhat passive. Now, passive can come in many forms. It could mean because you're being a lender, so you're not involved in the deal, right? But in equity investing, a syndication, being passive will spare you from having to deal with many of the operational complexities. The moment you're actually managing a plan, managing an investment, hands-on yourself, you definitely should get a little bit of professional advice will go a long way. Where I see these self-directed retirement accounts as being in the no-brainer territory is when you have hands-off solid assets, it's a no-brainer. There are some things now on the IRA side, your operational responsibility is limited to how you interact with the investments. You have no reporting. The reporting is done by the IRA custodian. However, on a 401k side, 401k actually has lots of potential operational compliance issues that you are responsible for. And if we see people sometimes don't have an updated plan document, people that are not filing annual reports they should be filing. And ultimately, it is the compliance responsibilities for managing and administering the plan are much higher on the 401k side. Now, we think it's worthwhile to have a 401k over an IRA if it's a good fit for you. But you are biting off a little more compliance responsibility when you get a 401k versus having an IRA.
Got it. Cool. Well, thank you for all the things you went over, Bernard, on going from the right fit, the right profiles, to some of the specific examples where things had been potentially run for others you've heard about. We're seeing to the last piece here. We are opening up for Q&A, and we have a question in the chat here again asking, can a limited partner in a syndicated real estate investment purchase shares with their IRA and also with their personal funds in the company as long as they don't have management responsibilities?
Yes, so long as they aren't, there is some nuance to this, but the general rule is so long as you are purchasing directly from the partnership, right, and your ownership in that partnership is not significant, then you can do that. Where does it create a potential issue? What happens if there's a minimum investment amount, right? And really you want to invest your personal money in there. And your personal funds available are $25,000 and the minimum is $50,000. And so you're like, you know what? I'll throw in $25,000 from my IRA so that I can get my personal 25 in. That might be a prohibited transaction. So for that, to get by that, you don't want to, typically want to be able to show that, hey, you could have done this on your own. And where this comes in, it's not what we call a per se prohibited transaction, but it could be what we call either self-dealing or there's something called the exclusive benefit rule. It's let's call it another dimension of self-dealing. That's done with your IRA has to be for the exclusive benefit of the retirement account. It can't be the benefit of anybody else. So you don't want to be saying, hey, I'm hitting that minimum. But if you're doing it because it's really, hey, I can hit the minimum both ways, I just love this deal so much, it's typically doable.
Got it. I think that's the main question. And I think if that person is a co-managing member, it would just be in violation of the self-dealing we talked about. I think that's all the questions in the chat, Bernard. And thank you for taking the time to talk through this. We definitely dived into a lot of the potential issues that people could run into that I haven't really heard people talking about it so much. And I love the perspective of, looking at your profile and see if it's a good fit without worrying so much other stuff down the road, like you'll be taxed, etc., and try to look at the case holistically versus try to worry about taxes so upfront, so early in the process. So thank you again. I don't see any other questions in here, so I'm going to stop the recording. And thank you guys for joining in. If you have questions, please follow up with Bernard Reisz at his own LinkedIn. And Bernard, what's the best way for people to get in contact with you if they want to follow up?
So I'd say I'd say two things. Number one, this resource that we shared is available. It's a bit of my passion to create content focused on real estate investors. There's content there for 1031 exchanges, cost segregation, every aspect of self-directed investing. It has a great search feature. It is free to join. That's available at members.resurefinancial.com, members.resurefinancial.com. They actually provide services at resurefinancial.com. What we've done is on each of these 1031, cost segregation, self-directed retirement accounts, we've kind of created a streamlined process, and our focus is really getting it set up correctly, keeping the costs low, and hopefully getting everybody into the properly structured account.
I think a low cost is is good, especially sometimes it can get costly on a per investment basis when the cash flow is so low and you're working on appreciations on the deal. So thank you again, Bernard.
Thank you so much for tuning in to the American Dream Builder and Investor podcast with me, Missy Liu. We hope you enjoy the tips and tricks that others have used to build their American dream and their trinity of freedom. We would love for you to subscribe and leave a rating and a review. You can also find all the episodes and details on lifemissioncapital.com. Until then, let your life mission go wild.